In this lecture, you will learn about investments, financial assets, including examples of assets that are not considered financial assets, equity securities, and debt securities. Although theoretical in nature, these are important lessons that will serve as a foundation for the succeeding parts of this lecture series. The International Accounting Standards Board defines investments as assets held by an entity for accretion of wealth through distribution such as interest, royalties, dividends, and rentals, for capital appreciation, or for other benefits to the investing entity, such as those obtained through trading relationships. Clearly, one purpose of investments is to grow, increase, or accumulate wealth, or for regular income through interest, royalties, dividends, and rentals. Another reason for holding investments is capital appreciation, which pertains to an increase in the market price of an investment. Examples of investments held for capital appreciation include land, building, gold, silver, and other precious commodities. Other benefits or other reasons for holding investments referred to in this definition include ownership control, like in the case of investments in subsidiaries and associates, for meeting business requirements, as in the case of bond sinking fund, preference share redemption fund, and plant expansion fund, and for protection, as in the case of life insurance policy in the form of cash surrender value. Actually, investments are not directly identified with the operating activities of an entity. They occupy only an auxiliary relationship to its central revenue-producing activities. In other words, investments provide only supplemental or additional income to the firm. Investments include trading securities or financial asset at fair value through profit or loss, financial asset at fair value through other comprehensive income, investment in bonds or financial asset at amortized cost, investment in non-trading equity securities, investment in subsidiary, investment in associate, investment in joint venture, investment property, and investment in fund. Investments may be current or non-current. Current or short-term investments are those which are readily realizable into cash and intended to be held for not more than 1 year. Trading securities, for instance, are normally classified as current. From this description of current investments, it follows that those investments which are intended to be held for more than 1 year or are not expected to be realized into cash within 12 months after the end of the reporting period are classified as non-current. In the previous slide, where examples of investments are listed, we encountered the term financial asset. Any asset that is cash, a contractual right to receive cash or another financial asset from another entity, a contractual right to exchange financial instrument with another entity under conditions that are potentially favorable, or an equity instrument of another entity is a financial asset. Cash or currency is a financial asset because it is a medium of exchange, meaning used as an intermediary to facilitate the sale and purchase of goods between parties, and hence serves as the basis of measuring accounting transactions. Examples of financial assets that represent contractual right to receive cash or another financial asset from another entity include accounts receivable, notes receivable, loans receivable, and bank deposit of cash. Bank deposit of cash or deposit of cash with a bank or a financial institution, but not the deposit of a gold bullion in a bank because gold is a commodity. A contractual right to exchange financial instrument with another entity under conditions that are potentially favorable. A financial instrument is any contract that gives rise to both a financial asset of one entity and a financial liability or equity instrument of another entity. Conditions that are potentially favorable, meaning likely to be advantageous to the company, such as when the exchange will provide gain or cash inflow. An example is the option held by a company which entitles it to purchase shares of stocks of a corporation at a price which is less than the market value. Financial assets falling under the category of equity instruments representing ownership claim in an entity include investments in shares of stocks and trading securities. Supplies, merchandise inventory, property, plant and equipment, and even lease assets are not financial assets because although those assets provide opportunity for future inflow of cash or other financial assets, they do not entitle an entity to a present right to receive cash or other financial asset. Intangible assets, although non-physical like financial assets, also cannot be considered as financial assets for the same reason that they do not give rise to a present right to receive cash or another financial asset in the future. Same with prepaid expenses, which entitle an entity the right to receive goods or services, but not cash or another financial asset. Financial assets may be classified as financial assets at fair value through profit or loss, financial assets at fair value through other comprehensive income, or financial assets at amortized cost. Please take note that financial assets at fair value, whether through profit or loss or whether through other comprehensive income, include both equity and debt securities. But financial assets at amortized cost include only debt securities. In other words, equity securities cannot be classified as financial assets at amortized cost. This classification of financial assets depends upon an entity's business model for managing those assets, meaning the purpose for holding those financial assets or investments, which may be to realize changes in fair value, to collect contractual cash flows, or to collect contractual cash flows and sell the investments. Now, what's the difference between equity securities and debt securities? An equity security encompasses any instrument representing ownership shares and rights warrants, or options to acquire or dispose of ownership shares at a fixed or determinable price. Simply put, an equity security represents ownership interests in an entity. Owners of equity securities are known as shareholders or stockholders. It is important to emphasize that equity securities do not include redeemable preference shares. Treasury shares, and convertible debt. Redeemable preference shares are considered debt securities, not equity securities. More on that in a little while. Treasury shares are not equity securities because they have already been reacquired or repurchased by the issuing corporation and therefore no longer in the hands of the shareholder. Convertible debt, such as convertible bond, although it gives the holder the right to convert it into share capital, must still be classified by the holder as debt security prior to conversion. Be that the case, as you will encounter again in another video, the conversion feature of convertible bonds precludes or prevents their classification as financial assets at amortized cost. In other words, although from the viewpoint of the holder, convertible bonds are not equity securities but debt securities, convertible bonds cannot be classified as financial assets at amortized cost, but only as financial assets at fair value. Recall that generally, debt securities can be classified as any of these three, depending on the business model. But again, convertible bonds, although not considered as equity securities from the holder's perspective, but as debt securities, must be classified as financial assets at fair value, not as financial assets at amortized cost, because of its conversion feature into share capital or equity security. A debt security represents a creditor relationship with an entity. It has a maturity date and maturity value. Examples include corporate bonds, government securities, treasury bills, commercial papers, and redeemable preference shares. Because again, redeemable preference shares are not equity securities, but debt securities. A redeemable preference share is one that provides for mandatory redemption or repurchase by the issuer, or gives the holder the right to require the issuer to redeem or buy back the instrument for a fixed or determinable amount at a future date. We will continue in part 2. Thank you for watching.